I mean, 40 billion looks big, but if you think in terms of valuation, which is close to 7 times price to sales multiple in my estimate, that doesn't look very high. Now, this is what Uber has been trading at similar valuations in the US. And Grab offers two big differences compared to Uber, right? First is that a clear dominance in the food delivery, right? So Grab is highly dominant with almost 50% market share for the food delivery, and Uber Eats is not close as much in terms of market share. So Uber is a kind of behind in terms of market share, and this market share thing is very important because investors like to pay a big premium for the market leader. Let me give you an example of that. In the US, the number one player, DoorDash, trades at 12 times multiple. Uber Eats trade at about 8 times, and the smaller players like Grubhub trade at 3 times price to sales multiple. So, the difference in the multiple is a function of market share and the market leadership. And that's where actually food delivery segment of Grab Food is pretty good, pretty strong. And second point of difference from Uber is that Grab does offer you fintech exposure, which starts from the payment and goes to the lending, insurance, and wealth management, right? And this kind of exposure you don't get via Uber. So I think these are the two important differences, and you are basically kind of getting a similar valuation as Uber. But naturally, these two differences matter a lot and will result in a much higher growth than you can get elsewhere.
Will the fintech bet pay off in the wake of competition, you think? And if so, what sort of value would you ascribe to that business? Because in the other two segments, that's ride-hailing and food delivery, this one is a leader.
Exactly. So leadership is proven in the first two segments. In the fintech segment, leadership is not yet proven, and hence this whole listing will actually they'll raise funds, right? And those funds actually can be deployed towards fintech. And essentially, there's a lot of customer acquisition you need for the wallets, the e-wallet services, right? And from there on, you have to build the engine of lending and micro insurance. All these things, I think, need a big war chest. So this is high growth, but it's a cash burning business for the time being.
Yeah, this is sort of like a one-stop shop, isn't it, for a number of services that otherwise would have been provided by many different apps. But it is still a loss-making business, right? A loss-making business valued at $40 billion. So you've got to ask yourself, what do you think is the outlook for SPACs in general? Because just last month, you heard the CEO of the LSE saying that this could prove to be a bubble and could end badly for many investors. Is this a bubble that could pop?
I don't think so. And the reason is very clear. This loss-making is a function of trying to grab the market share. Okay, alternatively, if you don't try to grab market share and lower your cost to bigger scale, someone else, and because cheap money, right? And cheap money will be deployed by someone else. So you have to be that player who kind of gains the market leadership, builds the scale, lowers the cost, and ultimately when the money is not so cheap, and that is when you can be profitable instantly because you have built that scale already. So I think I will rather look at the market leadership for these high growth businesses rather than looking at the profitability in the near term.